Welcome back to Boni's Life, where we decode the chaos of the crypto markets and turn market noise into actionable intelligence. I'm Boni, and if you've been watching the charts this past week, you know we are standing at a critical crossroads. The crypto market is currently flashing an extreme fear reading of 8 on the Fear and Greed Index, and Bitcoin has slipped below the psychological $70,000 mark. But as any seasoned trader knows, where there is fear, there is opportunity. Today, we are going to break down exactly what happened last week, analyze the massive macroeconomic events hitting us this coming week, and most importantly, I'm going to give you the strategies you need to navigate these turbulent waters successfully. Let's start with a technical postmortem of the past week. Bitcoin is currently trading around $66,500, down about 3.4% over the last 7 days. We saw a significant technical shift when Bitcoin broke below the critical $70,000 support level, a level that had served as bedrock support through most of the first quarter. According to David Morrison, senior market analyst at Trade Nation, Bitcoin retested a mild resistance around $72,000, but was unable to push through, leading to a steady decline. The daily MACD, which had been recovering from oversold conditions, is now flattening out at neutral levels. This leaves us asking, is this a pause before a continuation of the February rally, or are we heading for a retest of the $60,000 lows? Ethereum isn't faring much better, trading just under $2,000, down 4.4% for the week, heavily impacted by the massive $15 billion quarterly options expiry we just witnessed on Friday. But it's not all doom and gloom. If we zoom out, the picture looks different. Sentiment's latest weekly analysis points out that Bitcoin is displaying unusual resilience. While traditional safe havens like gold and the S&P 500 have taken hits recently, Bitcoin has actually posted an 8% gain since early February, decoupling slightly from traditional equities. Furthermore, major whale transactions have plummeted to multi-year lows. What does this mean? It means the big players aren't panic selling. They are sitting on their hands, waiting for macroeconomic clarity before making their next move. Even Goldman Sachs analyst James Yarrow released a note this week suggesting that crypto prices may have reached the historical peak-to-trough average for this cycle, essentially calling a potential bottom, though he warned that trading volumes might fall further before a meaningful rebound. Now, let's look ahead, because this coming week is an absolute monster for macroeconomic data, and it will dictate where the crypto market goes next. We have a packed economic calendar that could easily trigger massive volatility. It all kicks off on Monday with a highly anticipated speech by Federal Reserve Chair Jerome Powell. The market will be hanging on his every word for clues about future interest rate cuts. Currently, Fed officials are signaling that rate cuts might be off the table for now, and if Powell confirms a higher for longer stance, expect immediate downward pressure on risk assets, including crypto. Then, we move into the heavy data drops. On Tuesday, we get the EU Consumer Price Index and the US JOLTS job openings. Wednesday brings USADP private payrolls and the ISM manufacturing PMI. But the undisputed main event of the week arrives on Friday. The US non-farm payrolls report an unemployment rate for March. This single data point has the power to reshape Fed rate expectations entirely. If we see a spectacular jobs beat, it signals economic resilience, keeping the Fed hawkish, strengthening the dollar, and pushing treasury yields higher, all of which are major headwinds for Bitcoin. Conversely, a miss below expectations could revive rate cut hopes, weaken the dollar, and spark a massive risk-on rally in the crypto markets. Adding fuel to this macroeconomic fire are the ongoing geopolitical tensions in the Middle East. Escalating friction and Red Sea shipping disruptions are keeping oil prices elevated. For crypto, the math is simple. High oil prices mean high inflation expectations, which means the Fed cannot cut rates. This geopolitical instability is a dark cloud hanging over global risk appetite, and any sudden escalation or de-escalation will send immediate shockwaves through Bitcoin and altcoin prices. We also have to keep an eye on the regulatory front in the US, where the Clarity Act and debates over stablecoin yields are causing frustration in the industry, especially following the expiration of the White House crypto czar's term without a replacement. On the crypto-specific calendar, we have some notable events to watch. Tuesday sees the Asta Chain Layer 1 launch and Mantle's VOOI onboarding. Wednesday is a big day with Cubic and Dogecoin mining starting, alongside a massive SUI token unlock of over 43 million tokens, which could introduce significant sell pressure for SUI. Finally, on Friday, the Kaya agenda item GP21 vote takes place. While these might seem like smaller events compared to non-farm payrolls, in a low-volume market, token unlocks and protocol upgrades can cause outsized volatility for specific altcoins. So, how do we trade this? What are the strategies for next week? We need to prepare for 3 distinct scenarios. Scenario 1 is the bearish case, a strong non-farm payrolls report combined with worsening Middle East tensions. This creates stagflation fears. The Fed stays hawkish, the dollar rallies, and Bitcoin likely tests the critical $60,000 support level. If you are trading this scenario, capital preservation is key. Tighten your stop losses, consider hedging with stablecoins, and look for short opportunities on weaker altcoins if Bitcoin breaks below 65,000. Scenario 2 is the neutral case, an inline jobs report and stable geopolitics. In this environment, macro takes a backseat and crypto trades on its own internal dynamics, like ETF flows and on-chain activity. We've seen spot Bitcoin ETFs experience net outflows recently, with over 3,000 BTC leaving on March 27th alone. If this trend continues in a neutral macro environment, expect range-bound, choppy price action for Bitcoin between $63,000 and $70,000. The strategy here is range trading, buying support and selling resistance, and keeping a close eye on the altcoin season index, which is currently sitting at a neutral 51. Scenario 3 is the bullish case, a weak jobs report paired with diplomatic progress in the Middle East. This is the golden ticket. Rate cut expectations would skyrocket, the dollar would drop, and risk assets would fly. In this scenario, Bitcoin could easily slice through the $72,000 resistance and target $75,000. If we see this playing out, you want to be positioned in high beta altcoins and strong layer ones like Solana, which is currently hovering around $82 but has technical targets of $105 if momentum builds. To wrap up, this week is not for the faint of heart. The combination of Jerome Powell's speech, the non-farm payrolls report, and geopolitical uncertainty means volatility is guaranteed. The smart money is currently waiting on the sidelines, as evidenced by the drop in whale transactions. Don't feel pressured to overtrade. Sometimes, the best position is no position until the market tips its hand. Keep your eyes on the $60,000 support for Bitcoin, watch the DXY, and let the macroeconomic data guide your bias. Stay sharp, stay disciplined, and I'll see you in the next update.